Most real estate agents, mortgage brokers, and fake gurus push 30-year mortgages because the monthly payment looks easier to handle. But I've never bought into that. If you can't afford the house on a 15-year loan, you can't afford the house. That's how I've always looked at it. Stretching a mortgage across 30 years doesn't make it more affordable. It just makes it more expensive. This video breaks down why a 15-year mortgage makes more financial sense. We'll cover real cost comparisons, rate advantages, PMI savings, faster equity, and why banks push long-term debt in the first place. Your goals are yours, but this is what's worked for me, and what I've seen work for people who actually retire early. Let's keep reading to see what I mean. Check out the full details by visiting the link in the description. Why you should trust my take on mortgages. I've been a real estate investor more than half my life. Early in my career, I was even a mortgage broker. I bought my first rental at 21. I've paid off more than a dozen mortgages early. I've seen every side of it. I'm also a CFA, which means I understand how money moves at every level. Rates, compounding, tax strategy, the whole picture. There is another thing I know. The word mortgage translates from Latin to until death. But it doesn't need to be that way. So when I say the 15-year mortgage is better, it's not just opinion. It's grounded in experience. That's why I speak on this with confidence. The real cost difference between 15 and 30 years. All right, let's cut to the chase, the real numbers. Say you're grabbing a $300,000 loan. At 7.1% over 30 years, you're coughing up $727,000 total. That's more than double the house price. The bank's making bank, raking in almost as much as the seller. Now, let's slash that. A 15-year mortgage at 6.4% interest? You're paying $468,000 total. That's a $260,000 difference. Same house, same borrower, just a sharper deal. The savings are even more dramatic when the mortgage rates are higher. You might be squinting at those numbers thinking, yeah, of course you save with a 15-year mortgage. The interest rate's lower. Fair point. So let's level the playing field and prove the shorter term still wins, even if the rates are identical. A 15-year mortgage saves substantially. Say both the 30-year and 15-year mortgages are at 7%. This is hypothetical. Shorter mortgages always have lower rates. I explain why later in this video. Same house, same $300,000 loan, same rate. Here's the math. For a 30-year mortgage at 7%, your monthly payment is $2,000. Over 360 months, that's $719,000 total. You're paying $419,000 in interest, more than the loan itself. Now, a 15-year mortgage at 7%. Monthly payments jump to $3,000, but you're done in 180 months. Total cost? $485,000. Interest paid is $185,000. The savings? Subtract the 15-year total from the 30-year. $719,000 minus $485,000 is equal to $234,000. That's right. Even with the same 7% rate, you're keeping over $234,000 in your pocket by going shorter. Why? Less time for interest to pile up. Same rate, same borrower, just a smarter move. The "I'll pay it like a 15" myth. This one's popular. People say they'll get a 30-year mortgage for the lower required payment, but they'll pay it like a 15. Sounds great on paper, and it works for a handful of people. But in reality, life happens. A 15-year mortgage forces the discipline. It takes willpower out of the equation. Every month you're building equity, not just scraping off interest. That structure works better than any financial resolution. The truth is, most people who plan to pay extra never actually do it consistently. It's a comforting story they tell themselves, not a financial strategy they live out. If you're banking on discipline over decades, you're betting against the odds. You build real equity faster. Equity isn't just about owning a percentage of your home. It's about freedom. It's the cushion that lets you pivot when you need to sell, refinance, borrow, or cash out. And on a 15-year mortgage, you get there much faster. In the early years of a 30-year loan, most of your payment goes toward interest. You barely touch the principal. It's a slow climb. With a 15-year, you're attacking the balance from day one. You're actually buying the house, not just borrowing space in it. And when equity builds faster, so does flexibility. That might mean pulling HELOCs for investments, or just having peace of mind knowing you're not upside down. That speed matters more than people think, especially in uncertain markets. Why 15-year rates are always lower. There's no trick here. Lenders charge less interest on 15-year mortgages because the risk is lower. The shorter the loan term, the less time for something to go wrong. So, they reward that with better rates. Historically, 15-year mortgages have carried rates about 0.5% to 0.75% lower than 30-year options. It might not sound like a lot, but over the life of a loan, it's a game changer. Lower rate, shorter term, less interest paid. That's a win on all sides. And the best part? That rate gap holds true even when the market shifts. When rates go up, the 15-year still comes in cheaper. It's one of the few constants in real estate finance you can count on. PMI disappears quicker on a 15-year mortgage. If you put down less than 20%, you're usually stuck with PMI. That's an extra monthly cost that doesn't help you own anything faster. On a 30-year mortgage, it can take years to reach the point where the lender lets you drop it. But on a 15-year, you hit that 20% mark in a fraction of the time. In some cases, PMI's gone before you even notice it. That's real savings every month and one less thing dragging down your budget. More importantly, you get that feeling of progress. You see it in the numbers. You own more, faster. That momentum matters, especially when you're trying to build net worth, not just tread water. Dave Ramsey gets this one right. I don't agree with everything Dave Ramsey says, but on mortgages, he and I see eye to eye. He's made it clear for years, 15-year fixed. Nothing more, no exceptions. The reason? It keeps you out of the trap. It forces smarter decisions. It doesn't give you room to fool yourself with flexibility that ends in 30 years of payments and mountains of interest. You don't have to be as extreme as Ramsey, but on this point, he's not wrong. Mortgages were designed to last a lifetime, literally. There's a reason the word mortgage comes from Latin. Mort means death. Gage means pledge. It was literally called a death pledge. That wasn't a metaphor, it was the plan. Banks created mortgage terms that could keep people in debt for life. The system still works that way. The average person ends up refinancing, resetting the clock, or upsizing just enough to never escape the payment cycle. Choosing a 15-year mortgage is how you fight back. It's not a pledge for life, it's a plan to be done with payments while you still have time to enjoy what you worked for. A 15-year mortgage speeds up your exit. If early retirement is on your radar, your mortgage timeline should match it. Dragging out home payments into your 60s kills your cash flow and delays freedom. A 15-year mortgage moves you toward ownership while you're still young enough to do something with it. I've never met someone who said, "I wish I had stretched out my mortgage longer." But I've heard plenty say they wish they'd started knocking it out sooner. Retirement isn't about an age, it's about control. And when your house is paid off, you're holding the keys to more than your front door. You're holding the keys to your time. Most people are house poor because of the 30-year trap. You know the pattern. Someone gets approved for a big loan, then stretches their budget to buy the forever home. The monthly payment barely fits. Then property taxes rise. Then repairs hit. Suddenly the house is the boss, not the asset. A 15-year mortgage filters that out fast. You can't buy too much house because the numbers won't let you. That restriction isn't a punishment, it's protection. It forces clarity. You buy what you can actually afford. You own it sooner. You get your life back. Want flexibility? Build it into your budget, not your loan. Some argue they want the smaller required payment on a 30-year in case of emergencies. That sounds smart, but it's flawed thinking. If flexibility is the goal, build a cushion in your savings, not in your mortgage. If you're budgeting like a 15-year buyer, you can always drop to minimum payments in a pinch. But starting low and planning to pay more? That rarely works. Discipline works best when it's baked in. That's what a 15-year mortgage does. It removes the guesswork and locks in your progress. You don't have to decide each month if you're going to move forward. You already are. The real win: ownership and freedom. At the end of the day, this isn't about loving or hating debt. It's about control. You can either own your house or your house can own you. And stretching out a mortgage for 30 years is one of the fastest ways to stay stuck. When you take on a 15-year mortgage, you put yourself in motion. You lock in equity, speed up payoff, reduce interest, and free yourself up to build wealth with real traction. That's not theory. That's how I did it. That's how I've seen others reach the point where work becomes optional. You get to decide what your money does. You just have to make sure your loan structure matches your goals. Own it sooner with a 15-year mortgage. Mortgages were designed to feel like forever. They're marketed as a way to get in the game, but they're also a way to keep you in debt long enough that ownership feels out of reach. The 30-year loan stretches that trap just far enough that most people never make it out. But it doesn't have to go that way. You can choose a smarter path. One that cuts through the noise, ignores the sales pitch, and puts your future back in your hands. Forget the idea of making payments for the rest of your life. You deserve better. A 15-year mortgage doesn't just make sense, it makes freedom possible. Thanks for watching, and if you found this video helpful, don't forget to like, subscribe, and share it with your friends. Also, don't forget the link in the description.